the phases into 4 different parts. What I call as phase 0, which is pretty much the startup phase, where the company needs to be clearly capitalized with promoters' equity, and I sort of use promoters' equity in a loose sense to include capital coming from close friends, relatives, and family as well. And then the SME sort of goes through an early phase, which I call as the consolidation phase for the SME, which is about getting the business model, getting the initial set of customers, getting the initial revenue and business traction, and sort of confirming raising the entry of the business, as in why do we exist, is there a rationale for my business to exist, and are there any takers for the business model that I have. Once it gets established, then the next stage is to take this to the next level and see if there is a broader acceptance. And once that is done, the company can go on a pretty high growth trajectory, and by which point of time the external factors in the market and the internal elements of the company are also very well set. And to give a quick recap of the basic financing options that are available to organizations at these points of time. Obviously, startup phase, it's more of promoters' equity. The early phase, a lot of people, and this is a very important phase, a lot of people keep scouting around for capital at this point of time without realizing that internal accruals are probably a good source of capital at this point of time. And as the company moves into the initial growth phase, debt and venture capital options start opening depending on the nature of the business. And of course, in high growth phase, private equity, which today is a very, very used and abused term in various contexts, starts becoming available. Debt also is an option. And once a company reaches, I've not covered this phase, once a company reaches a maturity to consolidation phase, that's when a public offering becomes relevant. But I guess most of the audience that I presume here would be either in the phase 0 or early phase of the initial growth phase, so we'll probably not touch upon this maturity phase. Moving on to the next slide, the startup phase. As I told you earlier, it's important for promoters to bring in a reasonable amount of capital, not necessarily from just self. This could include family, close friends, relatives, the circle that one has comfort and trust on. And the other operative term here is a reasonable amount of equity capital, because sometimes we've seen companies not adequately capitalized at this stage, and after that, they start scouting for funds, which is not necessarily an ideal option. So it's important to ensure that there's a fair bit of capital that comes in at this stage to ensure that the company can sustain till the business reaches a particular level of break-even and profitability, with the traction that I talked about earlier getting significantly established. The problem with debt and equity options are, as we stated here, it's too high risk for banks and financial institutions to provide debt. External equity, for the same reason, they consider it too risky, and it's too difficult to take a call on the business at this point of time. And hence, even if somebody is interested, the money is going to be available at a very high, low valuation, which sort of makes the instrument fairly expensive. So it's important to understand that promoters' equity is indeed the best and most viable form of capital at this stage. Moving on to the early phase, where the traction is getting established. As the traction starts getting established, depending on the nature of the business, some venture capital investors might start, or angel investors might start getting interested in this, but it's still a fairly high risk kind of a model. So you don't have too many people that are going to be knocking at your doors, or even if you were to knock at somebody's doors, they are not going to be very receptive to it. So external equity is still going to be at a premium. Debt, again, it's still going to be unlikely because of the continued high risk nature of the business at this point of time. And this is the point of time where the management, in addition to establishing traction in various aspects of the business, also needs to have a strong focus and emphasis on cash flows, the internal accruals. The internal accruals could take on different shapes. We could have working capital, we could have profit, basic, costs and profitability in the business. All of that needs to be managed. Capital costs need to be managed. So there has to be a very strong emphasis on cash flows. Every bit of money that goes in and comes out needs to be kept track of, which not many companies do. And even more importantly, for the entrepreneur, it's important not to waste too much of time in trying to raise, outside capital. I just want to sort of spend a little bit of time here. This is the point that I mentioned a little bit earlier as well. we come across a lot of companies which are in the early phase of growth, and they're all over the market. They keep attending, I don't know, 5 seminars. They keep attending, a lot of conferences where investors could potentially, come in, and they keep trying to talk to different kinds of people, spending an inordinate amount of time in figuring out if external capital is available. One, yes, it needs to be done, because with capital there's always a possibility that your business can grow faster. But the problem is, when there's too much of time being spent by the entrepreneur on this aspect of the business, when actually the time should be going to other more important aspects in the business, like either building the brand, or setting a solid platform for the operations to grow, or getting those initial set of customers, it's an inefficient way to spend one's time. If capital can be raised and people are winning, it's obviously a bonus. But we strongly recommend that people focus a lot more of their time, energy, and resources in building some of the internal aspects of the business. Again, depending on the business, it could be brand building, or it could be building customers, it could be building operations, it could be building the talent pool, or whatever. But raising capital generally should be last in the pecking order in the list of priorities at this stage. And we've seen people use very creative options where there is comfort to the customer. People have taken advances from the customers to deliver on the project, and that sort of, and obviously, which means the company needs to sacrifice or compromise a little bit with regard to what they can get in terms of profit margins and all. But that's a good compromise to make at this point of time, because capital is more at a premium. Business, obviously needs to grow at a faster pace. The other option that people could look at is when dealing with suppliers, rather than, obviously you need to work out very good credit terms with your suppliers, but then we have seen people work out equity-linked payments also, so where people get equity in the company over a period of time. It's a slightly tricky option, or a difficult option to work out, but again, it's important to select customers and suppliers who will work with you, will go along with you, and if that can be done, this is the most ideal form of capital that needs to be raised. Working capital is a form of capital, and if one can focus a fair bit of time on that aspect rather than raising external capital, you realize that the time is being spent very, very efficiently. And then we move on to the breakout phase, where the model has been established, the initial set of customers have been obtained, break-even has been achieved. That's when the focus shifts from cash flows to growth. And only when the focus shifts to growth does one need to look at external options, including debt. The debt option opens up depending on the capital-intensive nature of the business. There are a lot of technology companies, IP-intensive businesses, which will find it difficult to raise debt. But if it's a manufacturing setup, this is the next preferred form of capital that the company needs to look at. Along with the capital intensity, a couple of other things that one needs to look at is collateral availability, both personal collateral from the entrepreneur's side and collateral available from the company side itself. It could be in a variety of forms and shapes. And even more importantly, we are assuming that the company has reached some level of break-even or profitability. At least be in a position where the kind of debt that's being raised, you should be in a position to service that. And as I said earlier, if it's an IP-intensive business or a business that's more technology driven, venture capital options do definitely open up at this point of time. This is the time when the entrepreneur starts to go out into the market and look at various options, either on the debt or on the equity side. Still, it's important to have an eye on cash flows, internal accruals, and then in parallel go into the market and see if there are options opening up there. I presume the next slide is high growth phase. I presume not too many of you will be in this phase as of yet. But the reason I wanted to present it here is a lot of people get carried away by all the news of private equity fundraising that happens in the market, different kinds of companies, early stage, late stage companies raising private equity. So there's a lot of noise in the system. To put things in context, private equity is the most efficient form of capital in this phase, because your internal accruals are not sufficient to fund the kind of growth that you are seeing. You can't take on too much of debt. It can actually cause death to the company. So you need to be careful about debt. And a public offering should definitely be an option considered at a later stage, because it will be too premature. You need to be prepared for that. But then please remember that private equity investors are interested in high growth businesses. So they're also going to see this as a natural fit only when they are comfortable that you're either already delivering on that high growth or you have the potential to deliver that high growth. Otherwise, for a business that doesn't have the ability to generate a high rate of growth and returns, a private equity becomes a headache than others. And public markets can always be tapped at a subsequent phase when the company has reached a level of maturity. But broadly, to sum up again, early stages, it's important to look inwards, focus on internal accruals, cash flow generation, working capital, capital expenditure, ensure that you reach break-even profitability at the earliest, then start looking at debt and venture capital options depending on the nature of your business, and then look at external equity options at an appropriate time. Appropriate time is obviously relative, depends on the nature of the business again, but at a broad level, it's probably the last resort that you need to go after. So quickly getting to the rest of the presentation, a venture capital investor as opposed to a growth capital investor. A venture capital investor, I sort of define as an early stage investor who's taking a concept risk, who's taking a risk on the management team. So the aspects they look at are slightly different from what a growth capital investor looks for. So if you are confident and convinced that you need to look for venture capital investors, before you start to meet them or go out into the market, you might want to spend some time internally to figure out what your positioning to an investor is going to be. You better look at the market segment that you're addressing. You better start working out what is the size of the market, what potential exists for your business, what is the addressable segment, and how much of the market share can you garner over a period of time. It's good to be prepared on this front because this is one of the fundamental questions that a venture capital investor is looking for and is going to ask you. Management team is something that they look at very carefully, but that's obviously something beyond your control because you are what you are. But it's always good to build some level of diversity in your team, even at an early stage. Ensure that you're covering all bases in your business and something that makes it compelling for an investor to look at. And the third aspect is very often we come across companies which say that, there are at least 5 or 6 others already in the market. We see a huge potential. We also want to get in. And that's a weak argument to sort of present in front of an investor. It's important to understand what is the criticality of the offering that I'm doing. Again, all of these are pretty obvious. I'm just going to reiterate the obvious, but sometimes when you're in the midst of all your business chaos, some of these things slip your attention, so I just want to set the context. So it's important to look inward into your offering, into your product, into your services, see what is it that is different that you're offering compared to the rest of the market or what your competitors are doing, and be very clear about the positioning statement when you're getting in front of investors. When you're doing it purely for internal purposes, it's probably not as important, but when you're presenting it to third-party investors, it's important that you've thought through all these issues. And lastly, it's very important to establish from your own perspective that there is indeed potential for rapid growth, because as I said earlier, that if you raise capital and if you're not able to deliver on even reasonable growth numbers, you're going to end up with a pretty sad marriage with an equity investor. Getting on to a growth capital investor, this is the kind of investor who will come in when the company has established very good traction in its business and is sort of growing at a good pace. The factors that this investor looks at is slightly different. The emphasis is less on the background of the team. The emphasis is more on the strength, depth, and the professionalized management team that is there in place. The industry dynamics, they're all pretty clear. People just do basic reference checks on whether there are any fundamental risks in the business, are there adequate growth prospects, and people are not necessarily looking at very high growth rates here. The company needs to be in a position to deliver reasonably moderate to high levels of growth to ensure that their return expectations are satisfied. And last but not the least, they want to ensure that they're getting into a business which can scale and reach a size at which point of time the company can actually do an IPO. If an exit option is not showcased and presented to investors, it's unlikely that an investor is going to enter at this point of time. So it's very important to address that aspect which an investor looks for very, very carefully. The last slide in this presentation is about M&A, which might not be relevant for most of you, but it could still be relevant for some of the companies here, because very often people shut their minds completely to the option of getting acquired by a larger player or merging with another player in the market, and the most significant reason being that emotion clouds one judgment. And what we always strongly recommend is, it's very difficult to come out of that mode because you put in a lot of passion, you put in a lot of sweat to build this business. It's definitely not anything less than your own baby. So it is indeed difficult to come out of that mode, but we always advise and recommend that entrepreneurs try to come out of that emotional mode, take a slightly more objective view of the business, where it is headed, where the market is headed, look at what are the dynamics happening in the market and the business, and if M&A is sensible, is a reasonable option, it's something that one should not close one's eyes to. And I've just tried to list out a few areas or rather a few points when you might want to consider a potential M&A. And again, it's not that when these things happen, M&A is the only option. We have seen businesses which have sort of taken a significant dive, have gone in a completely wrong direction, and then eschewed the M&A option, avoided it, and sort of gone taken the hard path, done the grind, and gotten back on track. But all we are saying is M&A is always a worthwhile option to consider when, let's say, the market is flattening out or the industry is sort of stagnating for a variety of reasons. Many cases, the management team, when it started off, there was a lot of passion and emotion in the business. It dwindles over a period of time, fatigue sets in. It's important to introspect, take a call on whether you're still at the same level of passion to take the business forward. If not, M&A is something that you should very seriously explore. And the organization could have stagnated as well. There are no fresh ideas coming in. Competition is sort of outthinking us. So it sort of becomes difficult to compete in the market. M&A always becomes a worthwhile option. Of course, depends on whether they are interested buyers in the market at that point of time. Is there adequate excitement in the market to for somebody to come in and pay a price? But you will have to look at some of these options. Don't ever close out your mind to an M&A option, because sometimes that could be the most efficient way of delivering value to yourself as a shareholder. I think that's pretty much what I wanted to cover in the presentation. As I said earlier, I wanted to cover a couple of companies. One company on the technology side. I should admit that I've never ever interacted with the CEO of the company or with the promoters of the company, but there's adequate literature in the market, and we've sort of heard about them from many different sources, so I thought it would be a good example to cover. The other is a manufacturing company with whom we are working closely, with whom we've been associated for a while. We've seen their growth. Just to sort of drive home a couple of points, I'll come to those points after I cover these examples. The first company is a company called Zoho. I'm not sure how many of you have heard of it. It's a company that started about, I think, 6-7 years back. This is a company that was, in fact, they do what are called as productivity apps. I think, for example, this presentation that I'm sharing with you, I could have done it on the Zoho platform as well, if I understand the business correct. And that's a company that's competing very effectively with the likes of Google's and Microsoft's and beating them at their own game. And this company has not raised a single dollar of external capital today, and the company's revenue, from whatever we understand, run already into hundreds of crores, and very profitable at that. And for obvious reasons, they don't need capital because it's a technology company. They're very profitable, generating cash. So they've not raised a single dollar of capital till date. They are not going to raise a single dollar of external capital, to my knowledge, in the foreseeable future. And the founder of this company has this to say. When he was small and when he actually needed capital, he was out there in the market trying to raise money. There were investors who used to come and meet them. And the founders estimated the market size to be at around $2 million, which is, let's say, about 10 crores. max. And the moment they said that, the investors, the ad was taken out of the bubble, and the investors just used to, beat a hasty retreat. It was just not interesting enough from their perspective. And I think it was some kind of an enlightening moment for the company, because they realized that what is good for them as entrepreneurs is not necessarily good for investors. And it's a very important point that I want to drive home. There are a lot of companies that are looking at raising capital. Most of them don't succeed. Few of them do succeed, but a lot of them don't succeed because the investors don't find them investable. But then taking the argument to the other extreme, not all businesses actually need external capital. As I pointed out earlier, only if you are going to deliver a fairly high level of growth, you're comfortable that the market can absorb that, that is the time to go and raise external capital. If the market cannot absorb, or internally if there are certain constraints that will restrict the growth going forward, external capital can be a dangerous thing to do. So it's not just my advice, even the founder of Zoho has this advice to give to entrepreneurs, is that if you're addressing a small market which doesn't have great potential from an investor's perspective but is still interesting from your perspective, or let's say there are certain constraints, or let's say you have a certain level of ambition which is not commensurate with what investors are looking for, it's better to bootstrap the business with a small budget, rely more on internal accruals, and gradually build the business. If you build a good business which is good enough, which is strong enough, which has a potential, investors will automatically come back to you. So this is one case on the technology side that I wanted to bring forth. The other example I wanted to quickly share was a company in Bangalore called as Ashirwad Pipes. I don't know how many of you are familiar with it. This is a hardcore manufacturing company that started about 10 years back. They make specialty pipes. So this is a business that's reasonably intensive on manufacturing. They have a fair bit of technology element in their business. There is a reasonable level of brand building in the business, in the relevant community, the relevant markets that they are addressing. And this is a company which has huge capital requirements, but believe it or not, they have grown to a few hundreds of crores in a matter of about 10 years, or I would say less than 10 years. Bulk of the growth has happened in the last few years without having raised a single rupee or dollar of external capital. Again, it's not that they were not interested in doing that, but what they smartly realized was that in the initial phases, it was very important for them to establish the basic tenets and aspects of the business with regard to their marketing, with regard to their brand, with regard to their operations, with regard to their technology, with regard to their manpower. They focused on a lot of those elements, generated a fairly high level of cash flows at a very early stage, with which they were able to fund part of their expansion. And once that profitability was reached, debt was very easily available. They started taking on some debt, and they didn't have to resort to external equity options to grow their business. As we speak, at some point of time, they might be open to looking at raising, let's say, external equity, but then they definitely are not dependent on that. And I can say with a degree of confidence that the investors would probably be more desperate about investing in a company like that than the company itself would be desperate about raising money from investors. So the point that I wanted to drive home here was that very often companies and entrepreneurs focus on raising capital from outside, when it actually might be more efficient to focus inwards, spend time on the business, build the fundamentals. Once you do that, capital is probably the fuel that you need to accelerate the pace of growth. Capital is never a solution to any of the problems that you have. We've had companies which have stagnated for a while, and when you ask them, why you've not grown or why you're not profitable, the standard answer is that, we didn't have any, investors to back us, we didn't have any capital to back us, so we are in that situation. And my advice to all of them has always been that capital can never ever, irrespective of how well or how badly you're doing, capital can never be a solution to your headache or any of your problems. At best, it's a fuel if you're an automobile. At best, it's an energy boost or an energy shot that you would get, if you're looking at yourself as a body moving forward. Beyond that, capital is definitely not, a panacea or a cure for any of your needs. And I think that's a very important message that I wanted to communicate. Having said that, there are companies which are in a high level of growth. You definitely should look at raising capital from outside, debt at the right points of time, equity, but please look at those kind of options when you're prepared, you're ready for it, not before that. With that, I would like to sort of close out. Happy to take any questions from any of you. I guess the moderator is here, they'll coordinate.